Hello, I'm Sensei Kevlar. Thank you so much for joining me here in the dojo. If this is your first time, welcome. If you're coming back, welcome. I'm going to get right through the technical intro here because we got a lot of ground to cover and I really want to get to the meat of the matter of what we're really going to do. But I think it's important that we do lay the foundation for what it is that I'm about to talk about and the next coming 3 weeks. I've invited you all here because the technique that I teach works better when it's done in a group. People amplify the signals that we're using, and I'm going to show you that that is true, and I'm going to show you that the techniques that we apply are applicable even when the markets don't go in the direction that we think that they're going to go. Either you can, so that's the first rule of Dojo, is either you can see that what it is that I am, the first promise of Dojo is that either you can see what it is that I am doing is true because you can do the math yourself. You can observe it scientifically, repeatably, and it works every single time formulaically. Either it's true logistically or not. The second rule of Dojo is that what I'm teaching you is not advice. It's not something that I'm telling you should go to do to your portfolio. In fact, I'm going to be very specific about this. I'm asking you to stop trading. I'm asking you to stop applying any sort of buying and selling pattern to the market and stop and learn a new way of applying buying and selling patterns to the market. The best way to learn what it is I'm about to teach you is not by spending money. It's by doing it on paper. It's by doing the math. What I'm going to teach you is what I call paper trading. And I'm going to show you how this works and how it makes you profitable. I'm going to show you in a way that, again, per the first promise, is a way that you can repeat on paper with no money at all. And I'm not asking you for any money here to teach you this. The reason that this works is because when we all do this, when we all apply these plans in this way, this really does work and it all does make us more profitable. So that's part 3 of the promise, is I promise to try and be here for you to understand the process of what it is we're doing. And I promise to be here to try and help you master your profitability. But the rule that I really do expect to enforce here is if you take what I am saying and you go and you apply it to your portfolio, if you go and you actually start trading on the exchanges, you're really not doing what it is I told you to do. And if you come back to me and said, look, I lost money, I'm going to tell you, look, you should have only lost paper money. You should have never lost real money. That's not how we plan. So I'm going to make a basic assumption right now, and this is the only assumption I'm going to make through the whole dojo, and then like logic, I'm going to build all of our math and all of our activities based upon this one assumption, and I want you to follow along and make this assumption with me in good faith. And that assumption is that in order to make money, I need to not lose money. That's the only assumption we're going to make. Everything else is based around that very simple idea. Is if I want to make money, I can't lose money. So all of our strategies are going to be based around the idea that we are not going to lose money, and we're going to build strategies for not losing money. And either those strategies will not lose us money on paper, or we're just making stuff up. Again, this is not advice. This is just a technique that I want you to see and understand. And if you find the math is valid, then good, you have learned something. Let's dive in. Now, for a lot of you, I appreciate this is absolutely going to be review in every way. I appreciate that. I ask you to just stick with me here while we do some basic review. I'm going to go to my favorite charting site. Doesn't have to be yours. You can use any charting site, any charts you like. Tradingview.com, and I'm going to type in my favorite chart. ETH USD. This is Ethereum versus the dollar on the Bitfinex chart. I'm going to click that. Excuse me. I'm going to click on the full featured chart. And what it is I'm looking at, I'm just going to hit this button right here to get rid of all of the information that I don't want. What I'm looking at here is a price chart. I'm just going to zoom in with my mouse wheel. I'm going to zoom way in here. Right up to the moment. What I'm looking at here is a price chart. These are candles. These are candles that are aggregated into a 4-hour price action aggregate. So every one of these candles represents 4 hours of time passing. Then there's the next 4 hours and the next 4 hours. When the candle is red, what that means is that we opened at the top and then we closed at the bottom. So at the beginning of the 4-hour period, we were up here. At the end of the 4-hour period, we were down here. A difference of $111 to $109, $108. During that time, we also went as high as this wick right here and as low as this wick right here within that 4-hour period. But then at the end of the 4-hour period, we closed. Now with the green candle, it is of course exactly the opposite story. In this case, we started right here. We went as low as this wick right here before going as high as this wick right here and then coming back down and closing the 4-hour period right here. Now we could change this to be, 1 day. And now we're looking at a different aggregation of the same data, the same price action data. Okay. So what I want to point out to you is that these markets tend to go in cycles. And what's more is that these cycles are predictable. When I say predictable, I mean they're predictable in the same way that a coin flip is predictable, which is to say that it comes up with a probability of 50% heads or 50% tails. Now, that doesn't actually mean that when you go to flip the coin that you can predict from this what the coin's going to come up. You can't. That's the simple answer. That's not how this works. Instead, we have to come up with a very, very different strategy. One that actually allows us to be profitable when the coin flip comes up as many times as it does against what we hope it comes up. That's the answer. It's the only way that this works. So, in search of that method, what we're going to do is we're going to develop a scientific strategy that we can apply to any situation in a repeatable way, and we can test it right here on this chart. And we can test it and see if it made us money and how much money it made us. So the first thing that I'm going to notice about this chart is when it goes up, it goes down, and then when it goes down, it goes up again. It goes up, it goes down, it goes up. And when it goes way up, it tends to go way down. That's predictable. Not to the extent that I know that this is the top and this is the bottom, but to the extent that at some point, hey man, if it goes up, there's probably a pretty good chance that it could come down. And then if it comes down, there's probably a pretty good chance it could come up. Let's say it's 50-50. Let's say 50% of the time it comes down to here, and then it goes up to here, and the other 50% of the time it comes down to here, and it comes down more. That's reality. We can't predict. What we can do is we can come up with a plan for when it keeps going down. So the first thing that I want to point out is that when it does come up, I want to start establishing some vocabulary so I don't have to keep repeating these things. And that's a lot of what we're going to be doing is establishing vocabulary. First vocabulary that I want to establish here is when it comes up and it stops at the top here and has a turnaround on this chart right here, we call this resistance. So what I'm going to do is I'm going to take my line and I'm just going to put a line right here at resistance, okay? Then when it comes back down and it turns around again, the market is saying that I support this price point. They're saying here I'm going to resist this price point, and here I'm going to support this price point. So I'm just going to go ahead and take that line and put it right there. Okay. And here, what we see is that this resistance line is correlated statistically with this resistance line. When it came up and it encountered resistance at this point, it came back down and it encountered support at this point. Well, when it came back up again, it encountered resistance at this point. Could we have predicted that it would have encountered resistance at this point? Let's say that we can predict this with the reliability of a coin flip. 50% of the time, it's going to turn around and come back down. 50% of the time, it's going to go back up. Same thing with when it comes down. Can we predict it's going to do this? Well, we don't know. It's like flipping dice. It's like flipping a coin or rolling dice. You don't actually know how the dice are going to come out at the end. It could come out heads 100 times in a row. Same thing here. The market could keep going up. Same thing here. The market could keep going down. You don't know. But when it does, here we had it break through the resistance point that historically was seen right here. And when it did, it came back down briefly, and this point, which was this price point right here, well, it bounced off of there twice and found support there twice. Later, it did this again, and it came back down here, and at this point, which was previously resistance, we found support. At this point, it found support, but it kind of couldn't break through it, but kind of couldn't sustain it, so it broke through support. And where did it land again? Well, here was our support point previously. Did we get a little bit of a bounce back there? According to our volume, we did, and that's these lines down here. We got a real bounce right here. We got some real investors coming in here and saying, no, I'm going to deny this price, right? And an even bigger bounce over here when it came down here. Okay, so this is clearly the case where we were betting on heads and the coin came up tails. This is very clearly the case. We were thinking, oh man, for sure, it touched this point. It's going to go back up from here to back up here. And then it didn't. We need a plan that allows us to handle that situation. There's no two ways about it. So, abandon all hope, ye who think we can predict the market. Anybody who's telling you that they can predict which market the way is going to go, they're selling you a scam. They're selling you a lie. It's a different thing entirely, okay? So what I want to do is I want to come over here and I want to find that right here, you know, there was definitely some correlated resistance points. Coming up, it came back down. Let's see that a little bit better, a little cleaner here. Right, coming up, we definitely saw some real strong resistance levels right here. I'm just going to bring that down a little bit. Here, we saw it briefly gain support before it took off again. Okay. Here, we saw it do a real boost upward. Oh, I'm sorry, wrong button. Here, we saw it do a real boost upward, only to fall back down again and find support at this line before going back up. Here was the previous resistance line. Here was the previous support line. Okay. Now we have an opportunity for the future here, right? This is where the market does its turnarounds. These resistance and support lines are highly correlated. Did it come all the way down here and touch these? Not yet. Well, could it? Of course it could. And that's what I'm telling you, is when you roll the dice, you could come up 1, 1, 1, 1, 1 every single time. You don't know what's actually going to come up. There is no predicting the future in this regard. What we can do is we can come up with a strategy that makes us profitable when it goes up and makes us more profitable when it goes down and then comes up a little bit more. Because that's what it actually does. If you look at it, that's the real trend here. What we need is a strategy that when the market comes down and then goes up a little bit, we make a bunch of money. And then when it comes down and goes up a little bit, we make a bunch of money. And then when it comes down and it goes up a little bit, we make a bunch of money. The problem is we can't lose when we're wrong here. That's assumption number one. We can't lose when we're wrong here. We can't lose when we're wrong here. Okay. So if we bought up here, and then we're just not making any money down here, what can we do? So this is the first technique, and what I want to show you is called dollar cost averaging. And very basic idea. When you buy one position, let's say it's at $100, okay? When you buy one position and it's at $100, what you can do, sorry, wrong button there. Just going to open up my calculator here, all right? I'm going to buy $100 worth of ether. And then what's going to happen is, you know, maybe the price is going to go down to $50, right? So if at that point I buy $100 worth, right, I would have a grand total of 3 ether, right? But I would have paid $100 for the first ether and $50 for the second ether, right? So what I would do is I would dollar cost average. The way to dollar cost average is you take how much you've spent, $100 plus $50. Come on. Plus $50 plus $50. Okay. So you spent a grand total of $50, of $200. But you have 3 Ethereum at this point. Okay. So your profit point is $66.6. Well, what happened here is we started out buying, you know, up here, I'm just going to make up some numbers, pretend these are the numbers that I'm actually using, right? We bought up here at $100 and we bought 1 Ethereum. Then it came down to $50. And we bought 2 Ethereum, right? We doubled up on our position. It's like the martingale in betting, okay? Same idea. You're doubling up. And what you're doing is you're creating a new profit position because the profit position is here. That's where you will be profitable. All the market has to do is if you buy here and then you buy here, all the market has to do is come up and give you money and make it here, okay? So if this is your third buy, well, what are you doing? Well, you're taking $200 and you're buying, you know, 4 Ethereum at this point, right? Which gives you a grand total of 400 spent, divided by 4 plus 2 plus 1 is 6, not 7. Divided by 6. Okay. So, excuse me, clear energy. 400 divided by 6. No, I did that wrong. 4 plus 2 plus 1, 7, right? So 400 divided by 7. Okay. Instead of $66, now, because we bought down here, we doubled up in the martingale style. What we did is we brought this down here, right? We brought this down our profit line a little bit, right? Okay. So what we found here is that doubling up, well, it didn't give us the profit we want. As it turns out, the market wasn't generous enough, and it just didn't come up enough and make us any money yet, okay? So how could this have changed if we had tripled up, right? If we had started at $100 and then if, you know, we spent $150, right? We tripled up instead of doubling up, okay? And then divide that by, we now have 4, okay? So instead of 66, we're now at 62 on the first one. And what we're doing is we're moving our profit line down, okay? So this should be trivial to do. What we need to do is we need to sit here and we need to figure out the places where we're actually going to do it. We need to make a plan to actually do it. And that's what this looks like, right? The first place we're going to do one position at $100, right? And then we're going to do 3 positions at $50. And then we're going to do 9 positions, right? at $25, and we're going to make a plan for whatever the market does. Okay? Well, if this is what it takes in order to be profitable in these markets, if it takes us dollar cost averaging all the way down, well, what's the lowest we can go? What's the failure mode of the martingale? It's that this keeps going forever, right? Is that the need to continue to buy in more and more and exponentially grow your bankroll is forever. Well, what's the limit here? What is the limit for how much you need to grow your bankroll on this progression right here? Well, it's not infinite. It's finite. It's a fixed number. If I have tripled up all the way on this line and this line and this line and this line and this line, you know, I've tripled up all the way down to $6 on this coin, I know exactly how much money I've spent. There's no predicting the market here. What we've done is we've planned for when the market goes down. We've made a plan, and we can figure out prior to actually spending any money how much money we will have actually spent. And sitting here and doing this, well, it's tedious. Okay? So one of the lessons that I really stress is if you feel the pain, then this tells you the change that is required. Sitting here and making something in Notepad and doing the math in calculator, well, it's a pain in the ass. There's tools for this, right? Spreadsheets work really well for this. I mean, they're just incredible. And that's what I want to invite you to do. I really want to invite you to go and make a, not a document, sorry. A spreadsheet. Let's see if I got one handy here. I've got so many. It's probably in my other account. There it is. I've got so many. Let's go back and just make our own. This is the joy, right? Is going in there and figuring out how to do the math. And the reason that I'm asking you to do this is so that the math is second nature. Is so that when you go to actually make the plan, you don't actually have to do this craziness, right? So what we're going to do is we're going to say, you know, the first place is 100, the second place is 50, the third place is 25, this fourth place is $12.50, you know, come all the way down to $6, buy again for a last-ditch effort at $2.50. Okay? $2.25. What I want to point out to you here is this progression is finite. You know exactly how much you've spent, right? Because here you've spent, you know, you need to spend 1 and then equal to B1 times 2, right? And then equal to B2, or then we can just copy that, right? We can copy that on down. Okay. And now we've got our progression of how much we're going to buy. Okay. Then what we need to know is how much we actually spent in each place, right? So that is the sum of, no, I'm sorry, excuse me. That's A1 times B1. Then we can just copy that on down. Okay. And then what we need to know is we need to know how much we have spent at the bottom, which is the sum of C1 to C6. Okay. So at the bottom, we've spent $568. Now, if we know we've spent $568 at the bottom here, do we know how much we've invested before ever investing? My answer is yes, I know. We've invested $568. Okay, which means we need to allocate $568 of our portfolio. But we have a problem, which is that the math here, the 2xing, didn't make us any money. It didn't actually, come up and make us a bunch of money, right? So what we need to do is we need to increase this. Well, we've got a hard-coded number here, which is kind of a pain in the butt. What we really needed is we needed another cell to hold our multiplier. So we can adjust our multiplier, right? So if our multiplier is presently 2, what we can do is we can say times B10. Oh, no, wrong button. Fat fingered that. B10. Okay. Now what I can do is, instead of using a 2x multiplier, I can see how much I would have spent if I had used a 3x multiplier. Well, look at what happened. How much I needed to plan to spend changed. How much would I have made if I had used a 4x multiplier? Well, how much I would have needed to plan to spend changed. This needs to be my bankroll for this martingale strategy to work. If this is my bankroll, then I can do this martingale strategy in this market. Okay. The assumption that I'm making here with regards to this market is that this market won't go to 0. We'll talk more about diversification later. But what I want you to do is I want you to think about the ramifications of dollar cost averaging into a market and go and figure out what your actual dollar cost average is and how that makes you profitable. Okay? So then what you can do is you can just sell at 10% profit. You can sell at 15% profit. You can sell however much you want as soon as you're profitable. And now you have a strategy that's always profitable. No matter what. Literally, no matter what happens, barring the absolute worst case scenario, which is, the exchange gets hacked, the market gets delisted. No matter what the market does, no matter how low it goes all the way down to $2.20 and bounces back up, you've got a plan that makes you money, and assuming that you allocated your bankroll correctly. Okay? What's the other assumption that we can make? Well, we don't have to buy a whole Ethereum, right? What if we change this? What if we only buy half an Ethereum to begin with? Look at how our bankroll changes. Right? This is all dollars. This is all dollars. Right? Look at how our bankroll changes when we only buy half an Ethereum. Well, if you only have a small bankroll, can you make money this way? Well, it turns out you can. But you have to have a plan in place first. Okay? Can you figure out how much money you would have made? Certainly, just dollar cost average. This is how much money this is how much you've spent, right? And then dollar cost average this. Do it all in a formula here in Excel. I'm not going to show you because this is what I'm asking you to do as part of your homework. So you understand the formula. You take how much you've spent and you divide it by the number of positions you own. Grind this formula into your head. How much you've spent divided by the number of positions you own. Now go and make an Excel sheet that shows you how much money you're going to make. When it comes down and you dollar cost average in, when it goes up, and then this is how much we're going to sell at. I'm going to sell at 10% profit. I'm going to sell at 15% profit. Now go back in time and make a plan. Make a plan historically. Make a plan based upon the historics of this, right? Make a plan for the future. Make a plan that comes all the way down here. And then test it for, you can test it by doing this, right? You can test your plan to see if your planning was any good. By doing, if this is, pretend this is today. This is your biggest tool right here. pretend that this is today. You are here. You don't know what's about to happen. Okay? Do you make a plan to buy right here and then double up or triple up or quadruple up right here? Or what about right here, based upon this information? What is your plan for tomorrow? What is your plan for next week? If you plan the trade and then trade the plan, we don't lose money. Now, what people will teach you is they'll teach you things like, oops, I was wrong. You better put a stop loss down here in case it really does come down here. And what I'm telling you, that's a failure of planning. That technique that I just described, that's a failure to make a plan which keeps you profitable because you had that much bankroll to dollar cost average down. Okay? Now what we're going to do is we're not just going to do this for one opportunity. We're going to do it across a bunch of different opportunities. We're going to do it for Bitcoin and Ether. And what opportunities are we going to do it for? We're going to do it for any opportunity that has good volatility that we absolutely believe is not going to go to zero. Does this work for shitcoins? Yeah, it can, but they go to zero. That's the reality of the situation. If you want to know what coins are going to be around tomorrow, I'll tell you right now. Here's your answer. It's the top 10. These are going to be around tomorrow. You want more? It's the top 25. These are going to be traded tomorrow. The reason that they're going to be traded tomorrow is because their market cap is big enough. There is enough money invested in their motion to keep them going for as long as we need. Assuming that the exchange stays up, assuming that the exchange doesn't get hacked, assuming that the coin doesn't get delisted or, completely just, goes off the... That's the thing. Delisted. Even if it gets hacked, you can still roll back the chain. It has to be delisted for you to lose money this way. Those are the failure modes that you need to account for. And we'll talk about diversification more. But what I want you to do is I want you to practice going and drawing lines. Pick a market. Doesn't matter. You can come in here and do BAT USD, right? Do it on this one. You don't have to do it on a day chart. You can do it on a 4-hour chart. Let's get rid of all this noise, right? Let's bring in a little bit more data. We definitely see some support down here. Make that green. We definitely see some resistance up here. We'll make that red. Okay. What is your plan moving forward on this? Well, this is probably a bad example for this one. Let's do BTC USD. We know this one, right? Where we've got all kinds of prior resistance levels from back here. Let's bring in the... let's make this a 1-week chart. Bring in a little bit more data there. There we go. All right, here we go. Okay. Even on the week chart, you can see where your opportunities were. Here, let's go to the 1-day chart so we can see this a little bit better here. But here, you can see where your opportunities were. Look, I'm not saying that you could know to buy right here because of, some previous resistance point that happened right here. Support point right here. I'm not saying that this is always going to turn around here. I'm saying that if it's a coin flip, it's going to come down 50% of the time. The other 50% of the time, though, you can make money because you dollar cost averaged all the way down. Test it on paper. Go back and make a plan for buying and selling all the support and resistance points. See how much money you would need in order to make money, in order to get that multiplier right, in order to where it goes up and you just sell at a profit, and then you wait until it comes down and buy back in down here. Buy in, buy, sell. You know, here, back here, you buy, sell, buy, sell, buy more, sell. Here you're buying. Okay? If you can figure out how to do this on paper, if you can make the plan on paper work historically, if you can make it work now and in the future, make the plan. Make the plan for your buying plan down here, and then watch for the next 2 weeks. Spend no money at all. See if you would have made money if you had bought in here and then sold when it comes up, or alternatively bought more when it comes down here. Do it on paper. I look forward to seeing your charts. And next time, what we'll be talking about, we're going to, in the next charting session, what we're going to be doing is we're going to be finding lots of support and resistance points. And the next charting session, the next lesson after that, what we're going to be doing is figuring out ways to automate this and automate finding these types of support and resistance, and automate more of this, because there's nothing more dull than typing in math formulas. And the pain that you feel is telling you that the change that is required. Oh, I'm sorry. The final part I want to mention about automation, and with regards to, you know, this automation here. This is a form of automation where we're sitting here and not doing the formula ourselves, right? The final piece of automation that I want to show you is, if you know this plan right here, if you know that this is how much money you're going to spend when it comes in to this level right here, this is how much you're going to buy at this level right here, you don't actually have to wait for the market to come out down here and actually put in your order. If you know that if you know that you're going to allocate this much money for this buy at this level, well, you can go ahead and put this into the exchange as a limit order. In fact, right now, if you know all of your buys all the way down here, all the way down the market, because you've sat here and you've drawn your lines and you've done your dollar cost average, and you know exactly how much money you're willing to wager, that it's not, you know, you're saying, look, man, it's not going to go down to $50. It's going to bounce around 1,000. And it's going to trotter around there, and then it's going to come back up and make me my money eventually. Well, I need a plan for buying all the way down that's going to make me my money when it comes back up. Go make that plan. Make the spreadsheet. Figure out how much profit you're going to make. Go test it. And then put those orders in as limit orders on the exchange. Don't actually do this, but that's the idea. Actually, you know, the whole idea is you can just go ahead and put those orders in. You can put your order in at 3,000 for this much, for 2,000 at this much, for 1,000 at this much, for 500 at this much, for 250 at this much, for $100 at this much, however much it is according to your plan that you've allocated for. You can walk away. Likewise, when you know that you've bought this much, if you come in and you can set your sell order for that much that you've already bought, go ahead and set your sell order for 10% profit, 15% profit, and walk away, and now you'll have come back and you'll have made money. Either one of two things will have happened. Either you'll have